Portfolio Builder members, welcome back to a new episode. It's been a few weeks as we've been patiently waiting for inflation to fall to make any trade alerts. So we'll cover what's been happening and why we're still pausing on any changes to the portfolio. Currently this year, the S&P 500 is up 16% and our high risk portfolio is up 49%. First, we'll review the current positioning, and then we'll jump into a lot of charts and data to explain why we're still in a pause mode. In the high-risk portfolio, the unit of investment costs $4,689, and each unit has 4 shares of UVXY, 98 shares of TMF, the 3 times Treasury position, betting on the 20-year interest rates falling. We're long the dollar versus the euro with almost half the capital, EUO, which is, again, 72 shares. So that's our defensive side. All of those typically do well in some sort of stock market crash. Now, if the bond market's causing the stock market crash, obviously TMF won't do the job. Now, on the offensive side, we're still long Coinbase with 17 shares, and we're hedging against a resurgence in inflation with NRGU, which is 3 times leveraged position in the top US oil and gas companies with 1 share. The high-risk portfolio is up 51.5% year to date with a 2.28% drawdown this month. And again, we're just kind of waiting on the sidelines for the right price action to make some pretty big changes to the portfolio. The safe growth portfolio is betting big on bonds. So it is currently $2,068 per unit, has a 2-share UVXY position, 114 in treasuries, representing the largest position at 35% of the portfolio. And that's our defensive side, no dollar position currently, as it's loaded up on the bonds. And then on the offensive side, we're playing a lot of value plays currently. So we have Asia or emerging markets with EDC, 12 shares, that's EEM times 3. That index does extremely well during a period of interest rates falling and the US dollar falling, which again, they're gonna allow to happen most likely into the election to boost the economy and the stock market and keep tax receipts high. I think right now they're just trying to keep a tight setup to really kill inflation as we issue massive amounts of debt currently. We're long GBTC, which has been the best performer for this portfolio with 22 shares. And then we're long oil, which has been doing well in the last month with 1 share of NRGU. This portfolio is up 3.5% this year. And it's really just patiently waiting for bonds to do what they do and make a lot of money in probably in a year or two. Hold time is what I'm expecting for bonds. Okay, so we're going to jump into some charts. Here's the big issue in the market. You can see the Nasdaq's extremely correlated to the inverse of the US 10-year Treasury. And what's happened is the Nasdaq has gone skyrocketing up as the bond market's crashed. And so this is highly unusual. And most likely, either the Nasdaq's going to come back to the red line, the treasuries, or the treasuries are going to follow and have a huge catch-up trade to the Nasdaq. And the reason why I think we have this situation occurring is the big companies in the Nasdaq have had record profits and tons of hype around AI developments. So NVIDIA, Google, Tesla, companies like that have been driving the Nasdaq higher on strong fundamentals. And it's the bond market has been selling off primarily due to sticky inflation, which has been going our way. So we'll look at that. There's really only a few parts of the inflation picture that are still worrisome, and that's namely labor growth and commodities starting to go back up. But the big problem for the US is tax receipts have fallen dramatically, and the government's running almost $1 trillion deficit per quarter now. So this next 2 months, we have massive amounts of debt being issued, just shy of $1 trillion in the next 2 months. and they're starting to move down the Treasury curve. So much of the money Janet Yellen's raised since they increased the debt ceiling has been on the front end of the bond market. And the Fed has a reverse repo that has $1.8 trillion in it. So that's just been basically moving from the Fed's balance sheet to the Treasury's balance sheet and not crashing the bond market further. But now she's starting to issue longer term debt. So the next 2 months could be keeping bond yields elevated. And then after that in Q4 and then Q1 of next year, the issuance is going to really drop down quite a bit. And she's actually planning bond buybacks. So I think we have around up to 2 months of potential volatility or at least high interest rates in the bond market. And then we're going to see that red line catch up to the NASDAQ. So we still remain bullish on equities, cryptocurrencies, and bonds here. It's just taking a little bit longer than we were thinking here. This is a little technical chart on Bitcoin bottoming out at 29,000. And we've got a lot of reasons to think Bitcoin is going to break into new highs into next year. So we have Bitcoin ETF potentially coming out in September for BlackRock and 7 other big banks. We have ARK's ETF having some sort of commentary by Sunday. And then we also have Grayscale Trust lawsuit trying to appeal and get their trust converted into an ETF. We also have the Bitcoin halving. We have the election cycle, and we have inflation falling with massive deficits running. So this is a perfect setup for Bitcoin. This is the US long bond over from 1978 to current. And you can see the trend is lower and lower yields over time. A lot of this is due to quantitative easing. So we've got central banks, whenever their bond markets get in trouble, they always end up printing money, buying their own bonds, and forcing yields down. This is also due to automation, productivity growth, and demographics. It's also the only way these governments can continue to run these massive deficits. They have to engineer a setup where these yields go lower over time. Otherwise, everyone is going to lose a lot of money on the bonds that they're using to lend the government money. So we believe this cycle will continue the trend, and you'll see these bond yields probably break the low of the lockdown period, or at least close to it. And that's when we're going to likely think we're near a top in stocks and cryptocurrencies. So probably around 2025 to 2026, we could see these bond yields bottoming out. Okay, so here's a look at the deficit borrowing needed, $1 trillion this quarter, and then about 865 billion next quarter. And that's going to keep going a little bit lower, especially if tax receipts can pop back up. And again, Janet Yellen knows to keep the tax receipts up relative to how amazing it's been since we printed $6 trillion after the pandemic, that she has to keep running these huge deficits. So as long as productivity continues to increase and inflation falls, and we can get control over the labor markets, we really have a really nice setup for a boom come next year. Here's just another look at the Treasury issuance on the long bond, and you can see it's picking back up. So that's why they just sold today, actually, $117 billion of long bonds, and it did tick those interest rates up slightly. From Goldman Sachs, today's report, this was yesterday's CPI, it came in slightly cooler than expectations, which is good. Today's report, or excuse me, that's this morning. Today's report further reduces the possibility of a September rate hike, and consistent with our view that the FOMC will decide that a final hike is unnecessary at the November meeting. We continue to expect unchanged policy for the remainder of the year. How have assets performed after a Fed pause? You can see in 3 out of the last 4 periods where this occurred, the stock market boomed higher. That's because interest rates begin to fall, and that revalues stocks higher. Stocks are compared to bonds for valuations. If bonds have a very high interest rate, it makes the relative value of stocks lower. So as these bond yields fall, that's very good for the stock market, typically, as long as you don't have rising unemployment and go into a recession. And again, we're not seeing any signs of the labor market cracking. and inflation's been falling. There's one example where the market did not have a strong return. That was in the dot-com bust. That's because the inflation did come back, and the government decided to go into an account surplus. So rather than issuing debt, they actually tried to balance the budget. One of the few times the US government's done that in its entire history, and it created a 2-year bear market. Right now, we don't see any signs that we have any politicians that want to balance the budget. Only one investor can be right. Billionaire investor Bill Ackman says he is shorting US Treasuries if long-term inflation is 3%, not 2%. The 30-year Treasury yield could rise to 5.5%. In contrast, Warren Buffett has announced buying positions in 10-year US Treasuries. Shorting the US 10-year bond seems to be one of the most crowded trades at the moment. And this is notable. Buffett hates bonds. So for him to go along that, he must be getting a lot of deflationary data within the Berkshire Empire, which has a lot of retail exposure. So, okay, so what's the bear case for the market? It's essentially, now it's this. So we got the rising commodities, which are still in a range for the year, but the averagely hourly earnings continue to trend at a 5% increase. And this is outpacing productivity growth. So this is going to continue to put pressure on inflation as people are making more and more money, and we're not producing goods and services at the same increased rate as wages. Now we can see that the median wage growth has crashed from 7.5% now to 5%, and it is falling as we expect, and we believe this will continue. Now, this is the fastest rate hike in history outside of what they did in the 80s. And so, of course, this is going to have a lagging effect, and we believe the Fed's going to be patient and let it take its effect here. This is a chart looking at M2 supply versus CPI. And you can see with the M2 growth going slightly negative now, this is anticipating that as long as it remains in this shape, that we're going to have the CPI continue to fall. Now, I do want to note in the 2020 money printing spree, they increased the M2 supply by 20%, and they've only decreased the M2 supply by about 4%. So that's why we still have this very hot economy that keeps on trucking despite the record pace of interest rate hikes. US CPI keeps following the path of the PPI, and so tomorrow we'll get the new PPI. But again, all signals are pointing that inflation will continue to fall in the months ahead. Services inflation is to fade further according to ISM Services prices paid. So you can see that's still pushing all the way to 2024, where the once sticky services inflation is now starting to fall. If we believe China is a leading indicator for the global economy, we possibly have tightened too far. So we've actually seen China's CPI go negative. Their imports and exports are down 15%. They're still at healthy levels, but everything is falling rapidly. And their producer price index across most of Europe and China is now negative. In fact, in Europe, we're starting to see some double-digit negative prints on the PPI. One huge component of the CPI is the shelter in place at 35%. And for whatever reason, the BLS uses data that's a year old. So we have a clear idea that that part of the inflation is going to be negative for the next year. Now that data is starting to bounce up now and stabilize, but that's going to be a huge part of the deflation story over the next year. And again, it's counteracting against rising commodities. Commodities are going back up because they're predicting the Fed's going to pause here. Excess savings to run dry in Q4, and college loans are going to start picking back up. So there's going to be a lot tighter budgets in family households. And we're not worried about this crashing the economy because everybody's got a job and they're seeing wage increases. So again, we're looking at a very Goldilocks situation for equity markets and bond markets leading into 2024 after Janet Yellen gets done selling so much debt. And again, it's critical they do this to keep the tax receipts up in the US economy. Okay, Bitcoin halving cycle is due in Q2 of 2024, which is right after the final deadline for these big Bitcoin ETFs to be approved. And so a lot of things are coming together that are very bullish for Bitcoin and Ethereum. So almost all of our big bull runs have coincided with elections and Bitcoin halving cycles, as well as falling inflation and falling interest rates. So you're going to get the trifecta combo leading into 2024. Big development, PayPal is doing a stablecoin as an Ethereum token, and they have 430 million active accounts. Sleep on this if you want. Ethereum is becoming the money layer of the internet. Now today, the Fed comes out warning banks not to work with PayPal. So still a big internal war within the US government as to whether or not we're going to be friendly or not friendly to cryptocurrencies. But again, seeing the big banks and big corporations all jumping on into this space, we believe that it's going to slowly but surely be in favor of pro-crypto. Just looking at the massive short position on the US 10-year Treasury, this could be short squeeze. So if we continue to get cooling inflation and Janet Yellen gets done issuing this $1 trillion in debt in the next 2 months and 860 billion, eventually I believe these short positions are going to be squeezed, which means they're going to have to buy the 10-year Treasury to get out of the short. And it could create basically a massive amount of buying in a very short period and make TMF skyrocket up. So I'm actually looking at adding TMF to the high risk portfolio within the next 2 months in a larger position, as my conviction that this could potentially be one of the better returning assets with low risk at a value price leading into 2024. China export prices see the biggest drop in a decade. So we're now in negative territory. So again, all signs are showing that we're likely going to have falling inflation here. This is a forecast of year-over-year shelter inflation. So we can see it's going to go negative all the way to the end of 2024 based on the last 12 months of data. New York Fed global supply chain pressure leading the core PCE goods inflation 4 months ahead, showing that goods inflation should crash. We're also seeing this in e-commerce. Prices are now going negative. Finally, seeing a slowdown in credit, which of course, more credit being created is inflationary. So that's slowed down slightly. So really what we have is wage pressure, too many jobs relative to how many people want to work. And now we're starting to see commodity prices rise again. So gas, for example, is definitely going to put some upward pressure on the inflation print next month. So the government has to keep running these huge deficits. Otherwise, we're going to have some major problems. As Jeffrey Gundlach points out, the US budget deficit is near 9% of GDP in an economy not viewed as being in recession. That means if a year ago we actually balanced the budget, GDP would have been near negative 6% last 12 months. If rates stay at 5.5% long enough, interest payments will go up another $1 trillion. We're about at $1 trillion a year of interest alone. And so the point here is if the government starts talking about balancing the budget, we want to bet on a massive stock crash because it's these massive deficits that keep the tax receipts up and keep the stock market up. And here you can see us approaching a $969 billion interest payment per year at these current levels. So again, there's a lot of reasons to force those interest rates lower one way or another. Okay, now we're going to go look at some charts. We got the 2-year bottoming out or topping off at the 4.8 range. We believe interest rate hikes are done. The next question will be when they stop quantitative tightening. Here's TMF, the product we think will be one of the best returning assets over the next 2 years, down 27% this year. It's been a rough ride for bonds. And again, the latest problem has been essentially too much debt relative to tax receipts. Here's DXY hovering at 102. This has been a safe place for us to hide money in the high risk portfolio. If we believe inflation is going to surge again, we do want to get out of bonds belong the dollar and UVXY. If we think that interest rates are going to fall and that inflation is going to fall, we want to go long bonds, cryptocurrencies, and oil. Here's the yield curve, still inverted, so we can see there's higher interest rates on short-term debt than long-term debt. This has been manipulated on purpose by the Fed to essentially slow down the US economy and kill inflation. Here's FNGU, which we got out of at 159. It skyrocketed up to 200 and something and has pulled back to 175. I think there's more money playing either GBTC, ETHE, or coin, because typically those outperform the NASDAQ times 3. And this year they're not. Well, some of Coinbase and ETHE has. But in the last move up, the AI hype has made the NASDAQ greatly outperform cryptocurrencies. And then plus the cryptocurrencies are still having lots of concerns over the SEC trying to sue Coinbase, Ripple, amongst other players in the market. So far, it seems like they've been losing the battle, as the Taurus case judged that Ripple was not a security when sold in the secondary market. Today, they've officially appealed that, so we'll see how that plays out. Here's Coin, which has had a pullback. This is our current position in high risk for crypto exposure. And again, with the lawsuit, it's making it trade at a discount. So I still like this position a lot. GBTC up 129% this year, doing incredibly well. It's closed that gap in the value of Bitcoin to GBTC considerably, which is why it's done so well compared to Bitcoin itself. So I don't like jumping into the Grayscale Trust compared to Coinbase right now, because I see a better opportunity for a huge jump in Coinbase now that the discount window on GBTC has changed. So Safe Growth may consider going to Coin and pulling a profit on GBTC soon. EDC started off the year really strong as inflation was falling, and then as inflation resurged, it took a nosedive. Again, our view is that we've got about a year of deflation coming, and that the presidential cycle is going to lead to Janet Yellen doing bond buybacks to force yields lower. This will make the dollar fall and EDC scream higher. So we're remaining long that in the Safe Growth portfolio. Here's a long-term view of oil, just to give some context. It's really just a short move in the last few months that's driven oil back up. But in the context of the Russian invasion, where it skyrocketed to 120, we've been in a decline since then. And to even get the rise recently, we've actually had to have OPEC cut production considerably. Now, notably, the US was draining its strategic petroleum reserve, and that helped drive the cost of oil lower. Now they're actually refilling the reserve. So I do like oil plays as a good inflation hedge for the portfolios once we really believe the Fed's done hiking interest rates, which I think's there. So still waiting to make a lot of changes to the portfolio, but at least you have an idea what we're thinking. So here you can see NRGU skyrocketing up just in the last month from 300 to 500, and it could go much, much higher. But we're being a little patient to jump on that while we gather more data on the inflation picture. Here's that 30-year treasury going way out of trend. There's going to be a lot of money made just betting that interest rates are going to fall back down over the next few years. And your best way to do that is with TMF. Okay, gold stopped rising. One inflationary hedge. Again, showing signs that the market's starting to think that the inflation scare could be coming, could be going away here. Silver, same pattern. Okay, UVXY continues to just get smashed lower. I've been very hesitant to load up on that. I would like to add a little bit, but unless I think inflation is coming roaring back, I believe we're actually looking for a new leg higher in stocks, bonds, oil companies, and cryptocurrencies. Again, leading into the election. The regional banking crisis seems to be recovered and fixed. So far, no more damage in this space. We can see it's been essentially trading sideways now. S&P 500 is up 15% year to date. The NASDAQ is up 37% year to date. Russell 2000 small caps may be a good catch-up trade, up 7.5%. If we look at some economic data, the U.S. consumer keeps growing its spending to new highs, although the trade balance has been slowing down with China, and retail sales growth has been slowing down. We can see U.S. consumer credit continues to grow, but we have seen a little bit less loans out by banks, again, from all the regional banking crisis. China's PMI remains in positive territory, despite the dropping prices. And although they've had a drop in imports and exports, it's still at very healthy levels at 200 billion on imports and 281 billion in exports. Okay, very good. So that's our update for today. I'll go ahead and take any questions. Okay, Dawn says, I thought NRGU goes up as interest rates go up. Yeah, so we've seen some decoupling from that pattern. And so I actually think once it's clear that inflation is falling and the Fed's going to pause, that we're going to see pretty much everything go up together, bonds, stocks, and oil, because the Fed's going to let the economy run hot again. Now, if the overall inflation's hot, then I would bet the opposite, that bond yields go up, stocks and oil companies go down, because then they're going to start hiking interest rates again. Right now, the market's ready for a pause. Pat's asking if we should play BOIL leading into the winter. Yeah, so we've seen some big shocks in gas prices in Europe. I think there's some sort of strike that caused gas prices to jump 40% yesterday. But meanwhile, BOIL's down 10% today. I don't have a high conviction on the price of LNG. At this point, I'd prefer to play the much larger market, which is oil. So if we do get back into BOIL ahead of the winter, due to the Russia conflict, it'd probably be a small position and complement the NRGU position, which will be much larger. All right, very good, guys. Well, we'll be back with a new webinar next Wednesday. I just wanted to wait for the CPI data to come out today. Did do what we expected, but the bond market's still not happy. So until we see that bond market starting to squeeze out those shorts, we'll probably be patient for a little bit longer. So I want to thank everybody once again for joining us live, and we'll see you back next week.